an investment sales broker. I am the senior director of Encore Real Estate Investment Services. So we're a boutique net lease investment firm. All we do is triple net properties, which we'll discuss in a few minutes exactly what those are. But just to give you a feel for who we are in the industry, we have 37 agents. We work all over the country. Last year, we sold property in 44 different states. Between the 37 of us, we did $985 million in volume last year. And we're known as an industry leader in this space. So a little bit more about me and how I got my start in real estate investing and in commercial real estate brokerage. So I'm 39 years old. About 15 years ago, I got involved initially in house hacking, which for anybody who doesn't know, house hacking is when you own a property for the purposes of living there, and you utilize things like conventional bank financing at regular, relatively low interest rates. Maybe you do some renovation or value add to the property, and eventually you either move out and rent it or move out and sell it. So I've done that, 3 different times over, and that's really how I got started in real estate investing. For me, it was really that experience of being able to purchase something, add value to it, renovate the property, and then sell it for a number that was greater than the purchase price plus the renovations. So for me, that really started me down a path of single family home flipping, right? So the same concept, but without living in the property. So I went ahead and purchased a property, renovated it, sold the property. And I did this for years as I was working at my regular W-2 job. I had different jobs throughout the years. I was a development director for a large private school doing fundraising. I ran a sales team at a title insurance agency. And my most recent and my final W-2 job was actually at Amazon as a business development executive. So all the while I was working at these corporations, on the side, I was flipping houses. Fast forward to around 2016, 2017, that's when I finally left corporate America and went 100% into real estate investing as a house flipper. And eventually, as time went on, I transitioned from flipping houses to commercial real estate brokerage. So, the purpose of what I'm telling you today, I guess, is several fold. Number one, I'd like to, share some knowledge about triple net properties. I'd also like to discuss brokerage because I think that's an interesting topic where, if people do decide that they want to take that turn, in real estate investing and go the broker route, that's definitely something I know a lot about. But yeah, so my experience, in triple net brokerage really began about 5 years ago. And I got very heavy into the space. I still continue to flip houses on the side, but eventually decided that it was far more lucrative for me to focus exclusively on triple net brokerage. And the last few years, I've been selling close to $100 million of real estate each and every year. So let's discuss a little bit about what triple net is, right? I assume, I don't know you guys and girls, well at all yet, but I assume that most of your investing experience or most of your investing knowledge is in other classes of assets outside of the net lease space. Would that be, kind of a safe assumption? Okay, great. So, in order to discuss net lease and tell you what net lease is, I want to compare it to some other asset classes to show you what net lease isn't, right? So I think that most of you are familiar with multifamily investing, and even to a certain extent, maybe single family investing, right? So if one were to look at a specific piece of property, let's say a single family home, or probably for our purposes, a better example would be a multifamily building, right? So this multifamily building every month generates some gross income, right? So that gross income comes from things like rents. Maybe it comes from some ancillary income like laundry services, within the building. But you've got a certain amount of gross income that's coming in every month. That gross income, that's not what the owner of the building gets, right? That's the top line number if you look at his P&L. That's the cash flow that's generated by the property before expenses. But in order to look at what the investor's net operating income is, we have to consider things like all of the expenses for a multifamily property. So we'll have things like taxes, right? Insurance, property management, We'll have capital expenditures that occur. We might have capital X reserves. So, an account where money is siphoned off every month or every year and put into a separate account in order to pay for things like a new roof or maybe a new parking lot that are going to inevitably, occur at some point during the ownership of the property. We have things like property management. We might even have, a vacancy reserve, or we might have certain vacancy in the property. So at the end of the day, in a typical multifamily property, if it's bringing in, let's say, $250,000 of gross income, there might be expenses of $100,000 or even $125,000. So your bottom line, your take home, your net operating income is going to be your gross income for the property minus all of your expenses, right? And the same thing with the single family rental too, right? You own a property, let's say you're bringing in $1,500 a month in gross rent. Well, again, you'll have taxes to pay, insurance, you might have to pay for the lawn maintenance or snow removal. There'll be certain expenses throughout the time. You might even have to pay for things like property manager, et cetera, et cetera. So there are expenses that can be relatively controlled and fixed, but from month to month and year to year, they definitely do vary. Just as a simple small aside, something like snow plowing with the changes in cost of gas or salt prices could go up or down by 50%, from one year to the next. So there are significant changes that can occur in your expenses. Now back to our topic, triple net. So we're going to talk about several different types of property within the broader triple net, category. But the first one that we're going to talk about is the gold standard, and this is the absolute triple net property. So let's just dissect it a little bit based on the name. So the name triple net comes from kind of what we were talking about a minute ago. So remember before I mentioned with a multifamily, you have gross collected rents, and then you have expenses, and then you have the net operating income. Well, in triple net, right, the rent that the tenant pays to the owner is completely net to the owner. That owner has zero expenses, right? So the tenant pays for the owner's property taxes, the tenant pays for their insurance, the tenant pays for all forms of management and maintenance, and the tenant pays for any type of repair or maintenance to any part of the building. So these are, what we call coupon clippers. These are probably the most passive of all real estate investments that exist. Think about someone who's sitting on a beach in Florida and owns a triple net property in, Texas, never sees the property, doesn't go to the property. Every month he or she gets a check or an ACH, for the monthly, rental amount, and doesn't have to worry about anything. So that's an absolute triple net property. Now similar to absolute triple net, we have what's called a double net property. A double net property is exactly the same as a triple net property with one exception. Major expenses like the roof and structure, or in some cases the roof, structure, and parking lot, are the responsibility of the landlord. Everything else is on the tenant. So very similar to absolute triple net, but these major systems, like I said, roof, structure, and sometimes parking lot, are on the landlord. So in those cases, typically the landlord will hold a certain small amount of money every month. It could be 20 cents a square foot, it could be 25 cents a square foot in a replacement reserve, so that if and when those systems fail, they'll have the capital available to pay for them. And there's really some other simple equations that investors can use to determine how much money to hold back. Typically what I advise is like for something like a roof in today's market, roofs cost between $7 and $8 a square foot to replace. So what you do is you take the functional remaining lifespan of the roof, right? And you divide it, you divide the price of a new roof by the number of years that are remaining on this roof, and then hold that money aside every year, or divide that by 12 and hold it aside every month, so that you then have enough money when it comes time to replace the roof. Okay, so we've covered triple net properties, we've covered double net properties. The third major category of properties that we deal with are multi-tenant retail properties. So these are shopping centers typically, and they range anywhere from 8,000 square feet to 600,000 or 700,000 square feet. So this could be a neighborhood shopping center, or this could be a major, huge destination regional mall. So these properties are quite a bit more complicated than these simple triple net properties we've been discussing, but they hold inherent benefits, that triple net doesn't have. One of them is a diversification of income streams, right? Because with a triple net property, while typically we're dealing with major national tenants that have hundreds or thousands of locations, right? So they are very stable, very secure, very low likelihood that they're going to leave the location to go out of business. However, nonetheless, if that does happen, and the off chance that it does, you're now left with a vacant building. And those expenses that the tenant was previously paying, like taxes, insurance, and maintenance, are now yours. Well, with multi-tenant shopping centers, because you have many different tenants in the property, typically the termination dates of their leases are diversified, right? So you might have 10 tenants in your shopping center, and one of them has a lease that expires in 2024, one of them in 2025, one of them in 2027, one of them in 2030, one of them in 2032, et cetera, et cetera. So when one tenant has the potential to move out, you can fill that space, and you still have that vacancy offset by all of the income from the other tenants, right? So that's definitely a major benefit to multi-tenant retail. That isn't, it isn't common, obviously, with single tenant, whether it be a triple net or a double net property. Another great advantage of multi-tenant retail is that in many cases, these shopping centers, can be owned by what we would call like a mom and pop owner who maybe had the center, who maybe had the center as a property that they owned for decades, right? And maybe they just wanted hands-off ownership, and even though it was possible to raise the rents because the market rent kept going up, maybe they decided not to because they just didn't want to, didn't want the difficulty, didn't want the pushback from the tenant, didn't want to have to potentially re-tenant the property if the tenant said no. So in those cases, when a new investor comes in and buys the property, they may be buying a property where the average rent is, let's say, $9 per square foot, but in the market rent might be $12, $13, or $14 a square foot. So that's built-in upside potential, where merely by raising the rents, right, the owner is able to capitalize on that built-in equity that they now can create by raising the rent. So that's definitely one example of a benefit of multi-tenant retail. In a similar vein, some centers might be old and tired looking, and with some small capital expenditure and investment by a new owner into the center, they can now command those higher rents that we've been describing. So, another aspect that I want to touch on, with our topic of net lease in general, and why net lease can be such a lucrative and stable and attractive asset class for investors of all types, is that, if you look at the underlying fundamentals of the real estate, oftentimes we're talking about properties that are occupied by major national retailers. Think, Walgreens or McDonald's or Target or Amazon or Kroger or whatever a large shopping center, a large grocery store is. So these tenants are huge national retailers, and those companies all have their own internal real estate departments and site selection teams that are investing time and energy and resources and brain power to select those sites, right? So very, very often these properties, if you think about it, if you think about your average, neighborhood Walgreens, it's typically on a hard corner, right? Where one road meets another. There's usually a signal. So you've got a lot of traffic that goes in front of both sides of the store, and even a lot of traffic that stops in front of the store. Very well located real estate that was selected specifically for that location, for that tenant. So typically the underlying fundamentals of the real estate are very, very strong, and that makes it something that is attractive to an owner. And in the event that that tenant would ever leave in the future, in many cases these triple net properties are very easy to backfill or replace with another tenant because the underlying fundamentals of the real estate are so strong. So another thing that's important to mention about triple net properties or net lease properties in general is that not only do they have that stability and that security of having these major national tenants, that are providing guaranteed rent, because keep in mind, if that one Walgreens location doesn't do well and Walgreens decides to leave, Walgreens is contractually obligated to continue to pay you rent, right? Because the lease, in many cases, is a corporate lease signed with all of Walgreens. So unless the entire company went bankrupt, they would be forced to continue to pay rent for that location. So that's really important. So you've got stability and security And these are locations, by the way, that, because of where they're located, typically the tenant is doing incredibly large volume at the store. So like, for example, with pharmacies, it's not uncommon for a pharmacy to be doing 8, 9, 10, 12, maybe even $15 million in sales at one location, right? So the fact that they're paying a couple $100,000, it's not such a big, dent to them. So the likelihood of them staying is very strong. So you've got that stability and that security component that is very strong, in triple net properties. In addition, they're very predictable. What I mean by that is that when you look at a triple net property, it's backed by a lease, right? And that lease is typically 15, 20, 25 years or more, right, in duration. And again, it's typically signed by a corporation, so it's a very strong guarantee. But that lease spells out to the penny how much in rent the tenant is going to be paying you. So for example, it's not uncommon in certain leases to have 1.5%, 2%, or 3%, annual rental escalations built into the contract, built into the lease. So you know exactly what you're going to be getting every single year from the tenant. In fact, you can make it, or your broker can make a very simple spreadsheet that shows you the annual return, right, cap rate wise, and even the average return based on all of the income that comes in through the property each year for the entire duration of the lease. So that security and stability and predictability is very valuable to people, and it's very attractive to people. So I think in general that's just kind of like a high level overview of net lease. If anybody has questions or wants to go into some maybe deeper technicalities or maybe additional strategies that people can build wealth or make money or build equity within triple net, I'm happy to talk about that as well. So just for a second, wanted to open it up and see if anybody had any specific questions about any of this.
We're a small enough group that you can either just take your microphone off mute or put it in the chat. If you put it in the chat, I'll read it out loud for you. But Dan, I'll start off with how there was a good overview of triple net. How do investors, all the people here, almost all of them are from Intel and they're busy employees, and how do they get into or benefit from a triple net lease?
Sure. So really the answer to that question would depend on how much capital they're looking to invest. I mean, typically right now, you're looking at probably around the $700,000 threshold is where, the investments start. And really the market starts opening up around $1 million, and then $1.2 million, it's even bigger, $1.5 million even bigger, $2 million even bigger. So if you have, let's say 30% of that, right, because you can leverage with bank financing, then you can buy, you could buy by yourself as an owner. And again, very hands off. And I'm happy to talk to anybody offline afterwards if they have additional questions on this. But yeah, you could do it by yourself. If you have less than that, if you don't have that much money, and I know that Mario Martinez had asked this in one of the comments, yes, there are syndications. I often work with buyers. I use air quotes because it's not really like a person, right? It's a fund, or it's a group of people, or it's a syndication, right? So, I've seen funds that accept as little as $20 or $50 or $100,000 from individuals, and then pool the capital together and invest in like the syndication or fund model. So that would be, one way to do that, and I'm happy to make some connections that way as well. There's an additional way. This is kind of like it is a different method, but there are things like DSTs, Delaware Statutory Trusts, that essentially pool together hundreds of properties like this, and then offer fixed returns to investors. The other way would be to invest in a REIT, like a real estate investment trust. But in essence, there you're just buying a stock, stock in a company. But yeah, there are definitely a lot of ways to invest in triple net.
I was going to say, would it be fair to say that triple net leasing, the way you lease out the property, is fairly independent from the way you acquire it? You can use all the different acquiring strategies to get it, but when you turn around and execute on your business plan, your leasing structure, that's more where triple net comes in. So you can acquire it through a syndication or a REIT or any of those methods, and they can use triple net or not use triple net, both ways.
Yeah, and just to clarify, 99 times out of 100, when you're buying a triple net property, you have no say in the lease. The lease is already cast, it's already, inked. The exception would be if you're maybe buying a new development and you get in early enough, but even there, they're typically standard leases. So yeah, you're coming in and you're buying a property that has fixed lease terms, and you are able to look at those lease terms, and I highly recommend that you look through all the nuances in the lease. Because over the years, I've seen hundreds and hundreds of leases, some of which have clauses in there that make them far less attractive with just one little sentence, right? We can talk about examples of that if you guys like. But yeah, absolutely. I mean, you can buy the property, and that is separate from the agreement between the current landlord and the tenant. Brooke asked, are there any disadvantages to triple net? So like anything, of course, if I told you no, then you guys should kick me off, off this call, because there's disadvantages to everything. So if you're looking at a single tenant net lease property, my opinion, the disadvantages is that if the tenant vacates, and again, very rare, but if they vacate, you're now left with a building that is 100% unoccupied, right? As opposed to a multifamily building that has 100 units, very rare that it's going to go to 0% occupancy, or even a multi-tenant strip center. The nice thing is that you typically have a window of knowledge if the tenant is vacating. And there are some other nuances too. Like if you're in the market to buy a triple net property, one of the things I recommend is always asking the owner if the lease calls for sales reporting. In some, probably 50-50, depending on the specific asset class, but 50% of the time, let's say, the lease calls for the tenant to release the financials in terms of how well they're doing at the location to the owner. And if I'm owning a triple net property, I want to have sales reporting if at all possible, because that's going to give me a good idea of the health of the tenant and if they're going to be staying or not. If I start seeing those sales dropping, maybe I get on the phone and I call my leasing broker and say, hey, who could I get in here as a backup in case they leave? So that would be, I think, the main disadvantage to triple net. The other thing is that, it is a relatively higher barrier to entry in terms of price point, being that the real market doesn't start opening up until about $1.5 million. There are like, for example, single family rental, you can get in for, $200,000 or $300,000. So that would be another disadvantage. Now, William's asking a really interesting question. What if the company does not maintain the property? Great question, real live example. I've got a CVS pharmacy here in Michigan that I listed about 4 weeks ago. We just went under contract last week. There's 4 years left on the lease. And this is an oddball situation, but we're fairly certain that CVS is going to vacate the property at the end of this 5 years, or this 4 years that's remaining. And I went over there to take a look at the property, and I noticed little things like the building was getting a little bit grimy on the outside. They weren't power washing it. The parking lot was starting to get deteriorated. This is an absolute triple net lease. It spells out very clearly that a tenant is responsible for all of these repairs. So in that case, there's like what should happen and what does happen, right? So what should happen is CVS should be on top of this. And in general, 9 times out of 10, they absolutely are. However, in this case, because they're not, the recommendation for the new buyer is to get what's called a PCA, a property condition assessment, basically an inspection that will spell out from a professional exactly what is wrong with the building. These are not expensive, $500, $1,000. And then at that point, depending on his relationship with CVS, he or she could either send a letter directly to CVS, or probably more effectively pay his or her lawyer, $200 to write a nice letter per section, in the lease. You're responsible for all maintenance and repair. Here's a report showing that you're in violation of the lease. Please correct please remedy this defect. And they have to. It would be stupid for them not to. So again, not common, but when it does happen, and it happens here, they're going to leave. So like if they're going to stop maintaining any property, it's going to be one they're no longer going to be occupying. So great example, doesn't happen very often, but that's exactly what you should do. I assume Walgreens, this is from Doug. I assume Walgreens and others will partner with someone from the time of construction to lease up, correct? So do you mean, Doug, in terms of like a developer partnering with Walgreens to handle the build of the property?
Correct.
Yeah, absolutely. I mean, these corporations are not in the real estate business and they're not in the construction business. So what happens is these developers have major corporations have relationships with their preferred developers, and they essentially say, hey, this is our prototype, our current prototype. This is what we're willing to pay. If you can make it happen, we'll commit to signing a lease at this location. Developer, puts up the capital or gets a construction loan, builds the property, and then, about 180 days before rent commencement, they reach out to someone like me and say, hey, Dan, I need to sell the property. And then the developer just works on a spread, right? Which typically developers can make a lot of money doing that. Right now, with the interest rates having changed so fast, so quickly, and so much, developers are selling in many cases at a loss because their construction loans are floating rates. So that's how it happens. And then, just as a piggyback to that point, Walgreens and other major corporations, very rarely do they own their own real estate. So, most of these major corporations that you see all over the major thoroughfares of your own markets, they're not owned by the actual, business that's operating them. They're owned by people like you, people like me, real estate investment trusts, family offices, funds, et cetera, et cetera.
Dan, just out of curiosity, I want to piggyback off that point there. Why doesn't Walgreens or CVS, why don't they own their own real estate? Why go through the rental, the partnering to construct it and then to have them lease it back to them? Why not just own it outright?
It's a really good question. I mean, I think that I don't have the 100% answer. That's the truth. But I think that, number one, it's kind of like a similar question of like, well, why do the banks care? They're taking back these properties and owning, real estate owned assets or bank foreclosures, and they can sell them and make money. They're not set up to do that, right? Banks are set up to loan. Walgreens is set up to sell convenience items and fill prescriptions. So I believe that Walgreens doesn't want to tie up that much capital in sticks and bricks when they can use that capital to hire pharmacists and to hire, general managers and stock their shelves. So, from my perspective, that's why, they don't own their real estate. And I mean, if you added up all of the real estate that's Walgreens occupied in the country, I mean, you would no joke be looking at billions of dollars of real estate.
Sure. Hey, it just strikes me as interesting. I remember hearing a quote from the CEO of McDonald's when he was talking to, I forget, maybe it was his boardroom, where he asked them, what are we in the business of doing? And somebody said hamburgers, and he said, no, we're in the business of land. And McDonald's, for instance, owns all of their own buildings, and they haven't gone that route. So I was curious what the thinking is there, but I don't have insight into that either.
And McDonald's is an anomaly. You're right. McDonald's, they don't own all of their locations, but they own a lot of them. And McDonald's very rarely come on the market compared to other quick service restaurants. Quick service restaurant is one of my specialties. I love that product type. And yeah, they are definitely a much more real estate focused company than any of these others. So they're for sure the anomaly.
Interesting. You want me to read them off too, or you can read them either way?
Yeah, I can take them. Can you talk about, so this is from, I hope I'm pronouncing it right, Jalan Anderson. Can you talk about triple net from a tax perspective? I mean, absolutely. Real estate is such a great investment for so many reasons. And one of them is just the tax benefits. So, triple net properties in general qualify for the same exact type of tax benefits that other properties do in terms of depreciation or accelerated depreciation. Or bonus depreciation. There's certain types of properties within net lease that have more tax advantages than others for whatever reason. One of them, for example, is gas stations and with convenience stores. Another one is car washes. They qualify for additional tax benefits that other net lease properties don't. And I just want to dig a little bit deeper into a certain nuance within triple net that we didn't talk about as it pertains to tax advantages. So up until this point, we've discussed commercial properties where, just like every other commercial property investment that people are familiar with, you buy the property, you own the building, you own the land, okay, right? That's what we call fee simple ownership, okay? So that Walgreens on the corner, you own the building, you own the land, they rent from you, great. So in tax law, buildings, real estate, the sticks and bricks, those are depreciable. But land is not depreciable. You can't depreciate land, right? So if I own a vacant hill somewhere, can't depreciate it. So if I'm looking at my asset, that Walgreens, right, I can depreciate the building, I can't depreciate the land. So there's a certain percentage of my investment that is depreciable. Now, there's other types of net lease we haven't talked about. These are interesting. They're called ground leases, okay? A ground lease is where you own the ground and Walgreens rents from you, okay? So there's some advantages to ground leases, and number one is I own that hill, right, I talked about. Walgreens and their buddy developer said, oh, that hill over there, that's a nice location for a Walgreens. We want to build a property there. They come to me and say, I want to build a property there. I say, that's fine, but I like my land. So we come up with an agreement where Walgreens will actually pay to build the building. I own the ground, okay? And then Walgreens rents the ground from me. That's called a ground lease. Now, the major advantage of a ground lease is, well, what do you think the likelihood is that Walgreens is going to leave a building that they paid to build, right? They're probably not going to leave. That if they leave that building, they lose the building, right? So that's an advantage of a ground lease. It's a little bit stickier than other types of properties for the tenant. One of the disadvantages about a ground lease is my ownership is 100% ground, which means it's 0% depreciable, okay? So that's a ground lease. Now there's a third type that's a little bit more rare and definitely much more misunderstood, and that's what's called a leasehold interest or a sandwich lease, okay? So let's go back to the example of this Walgreens and the ground lease, okay? So let's say we make it a step more complicated, okay? So Daniel owns the building. Walgreens rents from Daniel, but Daniel now pays Dan the rent for the ground. So essentially Daniel owns the building, Walgreens owns nothing, but they want to be there, they rent from Daniel, but in order for Daniel to be there, he has to pay Dan, okay? So that's called a leasehold interest or a sandwich lease, right? Because it's sandwiched in between the tenant to the building and the building to the ground. Now, can anybody think about what's really advantageous about a leasehold interest? Keeping in mind that let's say, so in this example, the owner of the building does not own the ground, right? So the owner of the building, anybody have any ideas why that's such a great tax advantage in a leasehold? Oh, Ashish hit the nail right on the head. It's 100% building. A leasehold interest is the only type of real estate where you own something that has no ground, right? So 100% of it is depreciable. So that's kind of cool. That's like a neat little nuance that not everybody knows about net lease. Like Ashish said, very, very well said, you get all of the depreciation. Let's see. So can you talk, okay, we talked about the tax perspective. Tax advantages, we said, yeah, the depreciation is the biggest one. Are they similar to multifamily and single family? Yes, they definitely are. And then keep in mind, just like multifamily, single family, and net lease, you can do a cost segregation study and determine if it makes sense to have, accelerated depreciation all at once. Many times it does. And are there any tax benefits if a nonprofit tenant signs a triple net lease? That's an interesting question. So you're saying if you own a property and then you sign a lease to a nonprofit tenant? I don't know. I mean, I have sold some properties with nonprofit tenants in them, and I don't believe there were any advantages. There may be, but there are none that I'm aware of. Let's see.
I jump in here and say that for an interesting business, Sam Wilson a couple of years ago came in and spoke to this club on triple net leasing parking lots and how he was doing well with that.
Yeah.
So go to the club page internally Intel and you can find the talk there.
Yeah, and that would be another example. If you own the parking lot, that would be more like a ground lease, so depreciation wouldn't apply. But in many cases, like I'm dealing right now with, I'm listing a shopping center in West Michigan, and there's a huge parking lot to the east of the center that's not being used. And one of the things that the current owner was looking into before selling was putting an ATM on that end of the building, and then also putting charging stations in the excess parking, or renting to food trucks, just to increase that ancillary income, to give you some value add, right? To increase, because keep in mind, like if you're able to tweak something and make property cash flow 5 or 10% more, right? If you have a low cap rate, which you typically do in net lease, it's like a fulcrum, right? It really is able to tweak up your returns and increase your value very quickly. Okay, so we have a question here. Dan, what's the relative returns expected from N versus NN versus triple N? It's a tough question to answer because there's so many different types of properties. I can give you just kind of a rundown right now, like as of today. The bottom of our spectrum starts at around a 4 cap, and that's like your Chick-fil-A or Chipotle in California, like A-class real estate, top market, top tenant, long-term lease. Absolute triple net. Much more common right now to get deals like in the 5 cap range. 5 cap, 5.25, 5.5. Those are going to be like your quick service restaurants, like a Taco Bell with an operator that has a large number of locations. Because keep in mind, if you're driving down the highway and you see one Taco Bell, it might be completely different than another Taco Bell, even though they look exactly the same. In regards to the lease term, in regards to rental escalations, how much rent they're paying, and very importantly, who the guarantor is, right? Like one Taco Bell might be operated by, Daniel and I, we've got a side business. We've got, let's just say, 2 or 3 Taco Bells, and him and I are signing on the lease, right? Versus, someone like Yum Brands that has 1,000 locations, right? There's a certain premium people are going to pay for the deal that has the larger guarantee. So if you've got a strong guarantee, long-term, fast food restaurant in a good market with good traffic, you're going to be in the low 5 cap range. And again, that's absolute triple net. If you want to look more like, there's some absolute triple net property right now in the high 5 cap, low 6 cap range. Once you start getting into the double net range, like for example, the classic double net deal right now, at least, is like a Dollar General. Dollar General always signs double net leases. They're like almost always 10, sometimes 15 years long. And those deals, by the way, have just been going down in cap rate. Before this like interest rate change fiasco started going on, those were trading at like a 5.15 cap, which was unbelievable. Now they're more like at the 6.25, 6.5. Some of them, if they've got a couple of years burned off, can be at like a 7% or 7.25, right? And then like a single net, I mean, if I'm not sure what you're referring to when you say single net. If I hear single net, I think like a modified gross lease where the landlord's responsible for, more than just roof or structure. Maybe they have to pay taxes or insurance or something like that. So those will trade typically right now in like the 8 cap range. And then if you're looking at shopping centers, if they're extremely well located, they could be in the high 5s or low 6 cap. But your average everyday neighborhood shopping center, let's say 10,000 to 40,000 square feet, today is trading somewhere between 6.75% and 8%. There's even product available 8.25, 8.5%. As you get closer to 9%, typically there might be some deferred maintenance or what we call hair on the deal that has to be investigated. But that's like the general return. Yeah, Don asked a similar question. So I guess the answer to that would be anywhere from 4% to 8.5 or 9%, with the bulk of our properties being between 5 and 6.5% on returns. But keep in mind, almost all those deals have built-in rental escalations. So the cap rate right now might be 5.5%, but there could be 3% annual escalations, which are going to bump that cap rate up significantly over time. Ashish says, this is a great question. What's the typical loan to value for triple net, current interest rate for bank loans? Whew. Man, this is like this question almost gets my blood pressure going. Just because 13 months ago the answer was like 3%, right? We can let 3% and 25% down, and whatever amortization you want. It's changed a lot. So typically right now we're seeing loans for triple net property, right around anywhere between 5.75 and 6.25 interest rate wise, which by the way is fascinating because typically commercial loans are higher than residential loans. But for the last probably 8 months, we've seen commercial loans, actually lower than residential loans. Like, today a typical 30-year fixed, might be 6.75, 6.8. And I'm seeing quotes almost 100 basis points or 1 full percent lower for commercial property. Loan to value, we're seeing lenders really start to get more conservative. So now we're seeing like the 30 to 35% down, which is a significant change. What's also fascinating is that, if the cap rates in our industry, aside from dollar stores, which still haven't moved enough, but cap rates in our industry haven't moved that much, despite essentially 500 basis points of interest rate change over the last 13 months. So deals that used to work out 13 months ago may not make sense with financing today. So what we're seeing a lot more of is flexibility and creativity from the lenders to actually change the amortization. So if there was a deal that previously they would have only done a 20 or 25-year amortization, now they're offering a 30-year amortization because, as you know, with a longer-term amortization, your monthly payments go down, which will increase your monthly cash flow. So that's definitely cool. I personally expect there to be, a tightening in the credit markets, across the board over the next few months. I don't know how long it's going to last, just because of what's gone on with the bank failures over the last, 3 weeks. And Jerome Powell even made mention of this 2 or 3 times during his speech on Wednesday. That of this credit tightening and how that's not deflationary, but disinflationary mechanism. So, I think the lenders are being a little bit more cautious, but I will tell you that there's a ton of capital out there. The lenders are hungry. I mean, I get calls a couple times a week from loan brokers who want business, who are looking to lend money. I'm getting loan quotes on deals that I think are risky deals, but the banks, are willing to lend on. So there's definitely, liquidity out there as well. And definitely financing out there. I think these questions were for you, Daniel, and you answered, it looks like.
Yeah.
Anybody have other questions or other things that they wanted to discuss?
And maybe this might be a good point. I actually had a person from this club come in and ask, and I promised to ask this question during the meeting. So it's a little off topic, but she has a home that she has renovated into an elderly care center, and she is looking to refinance on it and is having trouble finding a bank that will lend on the better income that she's getting and not just on the single family home that she's converted. So if anybody knows a lender out there, she's in the Portland, Oregon area. Feel free to contact me and I'll put you in touch with her.
Okay, cool. I actually might know somebody.
Oh, great.
Yeah. Can you recommend some syndicators that offer triple net investments? Yeah, I can. So I've got a good friend by the name of Ben Kogut. He actually was with a large syndication company for years doing triple net investments, and he's since branched off and started his own firm. Great guy, good friend. I'd be happy to share his contact info, or if you want to reach out afterwards. I also have a guy locally here, also by the name of Daniel, and he has a few different types of funds. Some of them are single family, some of them are multifamily. I believe he might have a triple net one. I'd have to check. And I also have a client of mine who's purchased a few assets from me, who has a fund, and I believe is interested in taking on some new people. So I don't know, Daniel, what the best way to do it, if I'm able to give out my contact information.
Oh, absolutely, absolutely. Feel free to give out your contact information. I will also put it up on our Speakers Hall of Fame, where it'll be there. Our Speakers Hall of Fame, just for those of you who are wondering, is transitioning outside of Intel. And based on the poll that I see, which is open now in case you haven't voted in it, our new name is going to be Alternative Investing Club. So if you don't like that name, vote in the poll and let me know.
Here you go. So I put my email address. I actually spelled my email address wrong, I realized. So let me change that. That is my cell phone number. That's my correct email address, the second one. And that's my cell phone number. You can reach out, call me, text me, email me. Happy to make introductions. I think syndications are a great way to get involved in net lease. If you don't have or are not willing to part with $1 million, $1.5 million plus, it's a great way to test it out and get to know it. If there's anything I can do, if anybody wants to just talk real estate, or if you have a deal you're looking at and you want an extra set of eyes, I love this. I do it all day long, and I talk about it all night and all weekend. So I'm always happy to help. And it would be my pleasure to get to know you guys better. I'm also on LinkedIn a lot. That's how Daniel and I connected. So, if you want to reach out, connect with me on LinkedIn. My last name is Lukowitz, LEWKOWICZ, Dan Lukowitz. And I'd be happy to help that way. Ashish asked the question, what are the pros and cons of going through a syndication versus on your own? Well, first and foremost, not everyone can do it on their own because they don't have the capital, right? So that's why if you don't have the capital, then we're saying, okay, well, maybe try the syndication. Assuming that you have the capital and both are in front of you, I would say it's almost personality driven. Like me, I have a hard time investing in a syndication because I like control, right? So, I might want to own a single net lease property, right? So the advantage there is I have control. I can pick the asset, right? I can have my hands around it. I can be involved, and I'm like, the buck stops with me. Okay. One of the disadvantages, though, is that a syndication typically, first of all, they've probably been doing this for a long time, so they've got a track record and they know what they're doing, and they have certain metrics benchmarks that they have to get to in order to purchase a property. But in many cases, you can actually pool your capital. Let's say you're $50,000 or $100,000 across 5 or 10 different net lease properties. So that spreads the risk, right? So that is an advantage of the syndication model. It's really just going to be specific to the investor and their situation. And what I tell people is that the deal is so important. You have to underwrite the deal. You can't just trust the marketing paperwork that you see. Underwrite it yourself. Look through it yourself. Show it to someone like me. Show it to someone like Daniel who can give you their point of view. But you also have to know, and trust the sponsor, right? You have to make sure that you have a good relationship with whoever it is that you're going to be working with, right? Because ultimately, they're going to be the person that you're going to interact with if the deal goes great, and they're going to be the person you interact with if the deal doesn't go great. So that's super, super important. I guess from my perspective, if you have the capital to invest in a net lease deal yourself, I personally would look into that first. Not everyone is in that position, but if you are, I definitely would recommend it. Just because, like I said, then you have the control, and you're the decision maker. But keep in mind, you also have the risk too, right? You're going to be the one if you're getting a loan, you're going to be the one that's signing on the loan. And granted, there is a lot of non-recourse debt out there, but still, in many cases, you might have to make a decision if you're willing to sign recourse debt. So that would definitely be an advantage there. Mario says, are there better states and locations to have triple net? So I spoke on, I don't know if you guys know Vinky Lumba's, she has like a weekly meetup. I spoke on hers yesterday, and somebody asked this exact same question, and we were dealing exactly, the topic for that talk was like demographics and choosing a market. And from my perspective, I'm almost always going to go with the underlying fundamentals of the asset as opposed to the state, right? Because I'm investing in that specific location. So I want to know, what are the traffic counts? How much traffic is in front of this property? What are the demographics like, right? What's the 1 mile, 3 mile, 5 mile population? Very importantly, are those numbers increasing, right? Is there population growth? What are the nearby national retailers like? How many other major national retailers are in this market and in close proximity? What else is going on in the area? What's the occupancy like? Is my tenant paying below market rent or above market rent? Am I going to be able to backfill? So every one of those questions is going to better inform my decision than just knowing what state the property is in. Now, a caveat to that is that there are certain states in this country that are income tax-free states, right? They have no state income tax. So that factor can help to boost the cap rate, because I'm not going to have to pay income tax on the rental income, state income tax, I should say, if the property is in that state. So that's going to color my decision to a certain extent. But overall, I'm looking at the underlying real estate and the fundamentals of the deal much, much, much more than I'm looking at the actual, state or location.
Hey, everybody, can you take yourselves off mute and thank Dan for coming in and talking to us today?
Thank you, Dan.
Thank you, Dan. Thank you, Dan.
Thanks a ton, Dan.
Thanks, Dan.
Dan, appreciate it.
Very educational.
Thank you, Dan.
Thank you, Dan.
Thanks, Dan.
You're informative.
Thank you.
Thank you, Dan, for coming in and talking to us today. Did you have any last things you wanted to say? We usually close up right on the hour. Lots of clapping there. Uh-oh. Is it frozen? You there, Dan? Did you miss all those thank yous?
We're too much. We
Oh
inundated
no,
him.
yeah, we overloaded his network. If only it were just a series of pipes. All right. Well, everybody, next week we actually have the person on the phone who probably impressed me the most that I've seen with his knowledge. He is a finance person. He's a member of FINRA, and he often stars or goes into the talking head shows to talk about financing properties. He's been on CNBC, ABC, and various others. Dan, did we lose you there? Oh, you're on mute. I hope you heard all the thank yous that everybody just said.
No, you said you wanted to everyone to take themselves off mute and say thank you, and it was just dead silence.
Oh no! There was a. Can we do it again? Can we do it again, guys?
Thank you, Dan.
Thank you.
Thanks a ton,
Thank
Dan.
you, Dan.
Thank you.
Thank you. Appreciate it.
Thank you very much, Dan. We'll see
My
everybody
pleasure.
next week.
See you. Thanks, Daniel. Have a good weekend.